Welcome to the Daily Update, where I'll go over the action in the market for Friday, September 15th, and then we'll see how things are looking for Monday, September 18th. Well, we're chopping around right now. We had a okay day on Thursday where things were looking a little bit better, and we pretty much gave all that back on Friday. Now, it was quadruple witching, and that can be a day in and of itself. We're pretty much mixed in the technical picture. We're not trending right now. We have some negative things to be concerned about. We still have a day or two left of positive seasonality before we head into some more negative seasonality. So there's some things to be concerned about right now. Before I get started on that, over the weekend, I will be posting the videos from this past week. I did a 1 hour session on Monday and then another hour on Tuesday and another on Wednesday. I have to work through those and spruce them up a little bit before I'm able to post those. I want to post them all in one basic location on the YouTube channel and Rumble channel so they're easier to get to. But feel free to check those out if that's something that interests you. I talked about my own approach to technical analysis, then I went through strategies, and the third session dealt with areas of support and resistance. All right, let's go back and talk about what happened. We had a gap lower open. The market was more in mind to at least start the day lower. We went down below the daily pivot at 44.99. That's the 4,500 level. That's kind of the line in the sand mentally in the market right now. Prices then fell down below S1 at 44.85. And we also went down below S2, which was at 44.65. So we pretty much took off to the races to the downside right from the beginning. As the day went on, prices tried to build a bit of a base. We tried to bounce a little. We went a little bit sideways, but that really didn't take. So we kept falling. We went down to 44.50. Again, kind of another major strike price on an options expiration day. So the market was kind of gunning towards these different levels. And it tried to build another base after that. And we ended up closing near the low. We didn't really bounce up off of that level. We just kind of chopped around, came up just a little bit going into the close. We were down 1.22% on above average volume, way above average volume because of the options expiration. The technicals, as I said, are back more to mixed, and I'll show you some charts that kind of back that up. It's about inflation, interest rates, growth concerns. We've got the Fed coming up this week. We had some inflation reports that came out this past week. We've got weak seasonality. There's just a lot of different dynamics that are really making it hard to navigate the market right now. The comments that we can make, we're back below 4,500 and we're below the 50-day moving average for the S&P 500. And the strike that I alluded to, because I didn't know what was happening, I recorded it before there was the deadline and the announcement, but the United Auto Workers, they are on strike at the three major manufacturers. What's that going to do? Not only to stock prices for those companies, but what's that going to do economically? How long is this going to last? We don't know. There's a lot of variables right now. Mega caps and growth really underperformed in Friday's session. Those are the areas that have been leading the market higher. That just didn't come through. And believe it or not, when I did the video for Friday, we were short-term overbought with the Stochk RSI. Because we're not trending right now, after one kind of significant down day, we're now oversold with the Stochk RSI. That's how touchy this indicator can become. And we're trying to figure out, is there a new scenario? It's not really turned into a scenario yet. It's just more of a kind of a conglomeration of things and a variation on the scenario that we've been working with, that the economy is stronger than expected. The Fed will have to keep rates higher for longer, maybe even raise rates. And we're on Fed watch now, so we'll keep an eye on that. And then China's dealing with some economic weakness, which could impact the U.S. economy. And then oil just keeps going up, and that's producing inflationary concerns. The dollar was down slightly. It's been pretty strong lately. That's also been another reason for the headwinds with stocks. And interest rates keep going up, and that's also producing some concerns. The yield curves that we follow, even though interest rates are going up, we still have an inverted yield curves. Sentiment dropped down a little bit. We had been at 55, which is positive. We're still positive now, but coming in at 52. Our trend, we're not trending either in the short or intermediate term. The green line and the red line are back almost to kissing each other again. That's where we were after Wednesday. Then after Thursday, we were turning a little bit more positive. Now we're back to where we were before as far as our trend evaluation. And I'm keeping our bias and momentum at mixed because we have an up day, a down day. There's really nothing of conviction that's going on. The economic reports that came out, and these weren't major, so I don't have the charts behind them because they don't have a real big impact on the stock market. But in prices were up 0.5%, more than the 0.1 that they had thought. Import prices, when you take out oil, they were down 0.1% as expected, and what we had last time. Export prices came in up 1.3%. Last time they were up 0.5%. If you take out agriculture, we were up 1.7%. Last time we were up 0.6%. Then these are some of the areas that are a little more influential. The Empire State Manufacturing, which applies to New York, it came in at 1.9. Well, they expected it to be at -10. Last time it came in at -19. So this was better than expected. And then we had industrial production. This was one of the big ones. It came in up 0.4%, more than the 0.2% they had expected, but down from the 0.7% we saw last time. Capacity utilization, when we're below 80, that means that companies are not using all of their available resources to them. We're right on the edge now at 79.7. They expected 79.3. Last time we had 79.5. So a little bit better than expected and a little bit up from last time. And consumer sentiment, the preliminary reading came in at 67.7, lower than the 69.4 they thought was going to come in. Last time it came in at 69.5. So we are seeing a little bit more pessimism as far as how people are feeling. Here's the industrial production and capacity utilization year over year, where, and I have to move this here. The blue line is production, where we're coming down. We almost dropped a little bit negative, but we're starting to come back up. And capacity utilization is pretty much flattening out. And this is a different scale than the other reports. This is just looking at it on a year over year basis. And then we go to capacity utilization. This is just below that 80% level. When we get above that, that means that companies are more efficient, that they're using the things that are available to them. You don't have empty factories or areas that are not going to use that a company could use. They just don't have a need to do that. Then looking on a month over month basis at industrial production, where it declined, but it was still positive. Then we had consumer sentiment, where the blue line is the total number that came out. The yellow line are expectations, and they ticked up just a little bit. And how people are feeling right now is not very good. You've got a lot of different things going on that is producing some concerns, not only economically, but from a cultural standpoint, from a news standpoint, and people are feeling a little overwhelmed at times. Here's the chart that we look at, where the blue line is the consumer sentiment reading, and then we compare that with the 2-year Treasury yield. And these have been out of line now for quite a while. Almost 2 years now, we've been battling this, where they tend to go in the same general direction and they tend to not get very far apart, even though they're on different scales. They're still far apart and they're not really going in the same direction. We have people feeling worse while interest rates continue to go up. Then, keeping an eye on the Fed, there's a 98% chance as of Friday's close that the Fed is going to leave rates unchanged at the meeting coming up. They'll make their announcement this coming Wednesday. This could change, but it's been this now for quite a while. We can see the blue areas, that's how we are right now, than a day ago, a week ago, and a month ago. And it's gone up, and there's a little bit more conviction now, but there's been a really solid camp saying that they're probably not going to raise rates. So it's going to come down to what they say, not only in their initial statement, but then in the press conference that comes after that. And that could really have some impact on the market. Here's a study that we've been watching put out by Renmac, showing that according to this study, once we get above 4.02% on the yield on the 10-year, that's when it starts causing problems for the stock market. We're going up with interest rates. We were at 4.29%. We closed on Friday at 4.32%. Here's the intraday chart where we gapped lower right down below the daily pivot. We immediately went down to S1, shot down to S2. This is the sideways base that it looked like we were trying to build, but it just wasn't happening. So then we saw a bunch more selling coming in. We never made it down to S3, so I didn't put that on the chart. That was still a ways below where we were, but we came down to the 44.50 level, which is a nice round number, and that's just about where we closed. Looking at growth versus value, they were both weak, but growth is underperforming value. That's producing more negativity. And the growth to value ratio, it ticked up a little bit going into the end of the day, but we were down overall. So that's not showing much improvement. On a closing basis, we're declining when we compare growth versus value. We're still in a longer term uptrend, but we've just been chopping sideways since the early to mid part of March. Then keeping an eye on the VIX. This is another cause for concern because if we follow what historically has happened, that's the blue line. As this is going up, that usually means stocks are going down because volatility and fear are really picking up. So keeping an eye on the VIX itself, we ticked up with the line chart as well as the bar chart. We're still getting very low readings overall, and we picked up just a little bit with the volatility of the VIX as well. This is also a concern because we're looking at the equity put call ratio. This is continuing to climb, which is negative, but we're in an extreme positive area. So once we finally get to a point where we top out and come down, that could be positive for the market. We're just not quite sure when that's going to actually happen. And here's a longer term look at that same chart. You can look at other times when we saw spikes in this reading eventually. We just don't know when the spike's going to happen. And then a lot of times that marked a bottom in the market. Looking at the VIX to VVIX ratio, this had been looking a little bit better. It was starting to turn and go back up. Well, now it's starting to roll back down. And then, actually, that is positive, the fact that it's rolling down. When we're going down, that's better for stocks. And then this is also longer term, but this is more negative. This is a long-term moving average where we had been coming down. That was giving good support, but now we continue to go up. Then looking at the advanced decline line, we're looking at a slight decrease based on price and volume, but we still remain above the moving averages. So it's not like we're falling apart completely. Then the new highs, new lows, we're rolling over with the 5 period and the 10 period. Didn't see much of a change there because we're just bouncing around now as far as the market is concerned. So they're not really generating anything new. The advanced decline ratio is just about at the midpoint right now, suggesting things are more mixed. This is more negative. We're seeing a turn down with accumulation distribution, and we're below a declining moving average. This is trying to measure the smart money. And we're also showing more weakness here with the cumulative NYSE advanced decline line. We haven't quite come down to this previous low yet. That's negative, especially if we break below this. But right now, we're still maintaining above this upward sloping trend line. So it's hanging in there. The Chaikin money flow, which had been showing some improvement, is now going back to showing some weakness. And the ratio between risk on and risk off continues to show more short-term weakness. Here where we're seeing not a trend right now. We have the ADX below its moving average, and it's still declining. The green line and the red line are pretty much right on top of each other. And in the short term, they're also, the green line and the red line are showing the same thing on top of each other, and we continue to decline. And this is coming down to a very low reading. We haven't been this low for quite a while. And the longer we stay down here, the more potential there is that when a trend gets going, that it's going to be a strong trend. But we're just consolidating sideways for right now, kind of like a coil that's getting wound up. The daily chart, where we were able to get above the 50-period moving average and above this pivot level, well, we lost that in Friday's session. You can see the huge spike up in volume with the options expiration. Here's the Stochk RSI. We were extreme positive after Thursday. Now we're extreme negative after Friday. All right. And then our stochastic study, looking more weak now in the short term, turning down, but still above the midpoint with the intermediate term. And we're still advancing with the long term. And the force index, which had been showing some improvement, now it's starting to show some weakness. Dealing with the 20-period double and triple exponential moving averages, we were a little bit above it after Thursday. Now we're a little bit below it. And these two lines are almost on top of each other. And it looked like we were showing a little bit of improvement with our 50-period double and triple exponential moving averages. Now we're dropping below the red line again. So this is acting as some kind of overhead resistance right now. The go, no-go system is still looking a little bit more neutral, and you got all kinds of crazy colors on here, but it's negative overall. And we're continuing to chop sideways with our highest high, lowest low values. We had been above the midpoint. Now we're dropping below the midpoint. The TTM squeeze, it's finally starting to pick up some weakness. As we were going sideways and having up and down days, this oscillator continued to go up. That's when we see the lighter colored blue. When it goes down and changes to a darker blue, that means that things are weakening as far as that trend. And then the balance of power, we're just a little bit above the midpoint now, where it looked like we were showing some improvement. And the BPI still above 50, but not really showing any strength right now. If we drop below 50, that will be more negative. And the S&P McClellan oscillator, it had come back above zero, looking more positive. Now it's dropped back below zero. So the summation index based on price is turning back down, and we're starting to roll over again here based on volume. We were seeing some hope in this chart after Thursday that maybe things were starting to improve, but since we saw no follow through on Friday, that's turning this chart back more negative. We're also dropping below zero with the NYSE McClellan oscillator. So when we look at the summation index for the NYSE, we're declining based on price and volume. We went from being positive with the Elder Impulse system for the S&P to now going back to negative. The mass index, we're still wondering if some kind of a signal is being drawn here. We'll just have to see. We do have a valid signal here, not necessarily a strong one, but it's not really impacting the market. We're not seeing a real shift. The longer we get away from this, the more irrelevant this will become. Our oscillators with the PMO, we're going sideways. We're rolling over a bit based on price, and we actually showed a little bit of an advance based on volume. The PMO study declining with the PMOs that are rising. We were a little bit up with the buy signals, and we're pretty much flat now with the PMOs above zero. We were seeing some hope here with the Swenlin trading oscillator. It had been able to climb back above zero based on price and volume. Now they're turning back down. The NYSE bullish percent index continues to be more negative, and we're below 50. The NASDAQ 100 bullish percent index, it had been hanging in there for a while. Now it's in danger of turning more negative. We're still inside the Ichimoku cloud. We're wondering, can we break out to the upside, or are we going to break down below this? And the slope oscillator, this is our touchy one, and it was kind of hanging in there for a while. Now it's starting to roll over and go negative. The MACD is pretty much sideways with more of a negative slant. So all of our oscillators, the slope is turning negative. We're sideways with the TSI. We're turning more negative with the MACD, the PMO, and the PPO, rolling over a bit with our long term with the TRIX and the KST. So we're still seeing a mixed picture here with our oscillators. Looking at our 20-period moving average study, we broke down below the exponential moving average, and we're right back to the simple moving average. That could be positive, the fact that this is providing support. Looking at our 50-period, where we dropped down below the simple moving average, and now we're on the exponential moving average, this could also be providing a level of support. So our moving average tree, it looked like we were breaking out above the moving averages, and now we're coming back down into them. The Bollinger Bands, we were above the midpoint. Now we're right back down to the midpoint. Standard deviations, we dropped a little bit below the midpoint. In our open, high, low, close study, where we were breaking out above this little mini rainbow, now we're coming right down to the middle. The parabolic SAR still remains negative with the dots on top. The Chaikin oscillator, which had been showing some improvement, is now dropping below zero and turning negative. Money flow was also looking better, but now starting to decline. The ultimate oscillator was looking better, now dropping below the midpoint. RSI, we were right at the 50 level with both of these. We're dropping slightly below it with the 14 and the 9-period RSI. The MACD on a weekly chart is still continuing to show more weakness. And the Heikin Ashi, turning back to the filled up candles or bars here, so that's turning more negative. The Kegi is still positive with it being black, but it's negative because it's pointing down. where the Renko, we had another open block here, but we lost that after Friday. Where the 3-line break, it doesn't know what to do, so it's doing nothing right now. The equal weight index continues to underperform the S&P. The Dow, after getting a little bit above this pivot point and above its 50-day moving average, is now dropping back down. The diamonds went from being positive. The diamonds went from being positive back to negative. And we were getting above this resistance level with the NASDAQ 100 only to close down below it after Friday. The Qs for the Elder Impulse system have switched from being positive, now they are negative. And the NASDAQ 100 momentum that we've been watching, we're still above zero here, but we're starting to roll over. We're going to need to see some positive action to really help things for this indicator. And we're also coming into that weak seasonality. So it's looking very doubtful right now, but anything can always happen. With the NASDAQ, we were a little bit above the pivot point and the moving average. Now we dropped to down below that. We're not really dealing with this all that much. The 61.8% retracement level, when these are most powerful is when we're moving in one direction, we hit it, and then we move in the opposite direction. We've been chopping above and below this like it's a seesaw. But with the FANG index, this had been hanging in there above its 50-day moving average, only to lose that on Friday. Longer term, we're still in an uptrend. The small caps, which were showing some improvement, almost came back up to the 200-day moving average, only to come back down to the support level. And then when we look at the Russell 2000, we're still slightly above the 200-day moving average. There was some hope building that maybe we had hit this a few times now, and we're going to use that as support to bounce higher. And it may end up happening, but we lost a lot of that in Friday's session. And then the Elder's Impulse system for the small caps, they had switched to positive. Now they're back to negative. The mid caps still above this S1 level. We're looking a little bit better, but have been pretty much going sideways. And they're looking a bit stronger now than the small caps. But they have switched back to negative for the Elder's Impulse system after they had been positive. The transports, they turning up just a little bit with the Dow, or compared to the S&P, excuse me. And so we're going to need to see more follow through with this. But was that transport weakness or S&P 500 strength or the opposite? We need to see more of a trend develop here. Yields did go back up in Friday's session. So looking at Tom Bowley's research, we're coming kind of at the end of this middle part where we see some positive seasonality. According to the Stock Traders Almanac statistics, which I'll bring up here in a moment, we have maybe 1 day left of this positive seasonality. And historically, Monday tends to be pretty strong. And then we start hitting a pretty negative time for the month. Now, I could do totally the opposite of that. We're just going with what we're seeing right now and based on what history is telling us. So our outlook for Monday, we're still dealing with earnings season. The quadruple witching was really the story in Friday's session. And now we're dealing with the United Auto Workers being on strike. We're still wondering, is there going to be some kind of a government shutdown that comes along as the politicians play their little political games? There will be the student loan repayments that will be starting. What's that going to do to the economy? What's that going to do for money that has been coming into the stock market? The technicals are back to being mixed and we're not trending. We will get the NAHB Housing Market Index on Monday, and then we're keeping an eye on all the different geopolitical events. It's kind of about the Fed right now and what are they going to do? Not so much with interest rates, but what are they going to say at this upcoming press conference? Here's the new calendar for the upcoming week, where we will get the announcement on Wednesday, and then we're going to get LEI, those are leading economic indicators, on Thursday. And so there's a lot of reports coming out, but other than the Fed, they're not that influential. They just try to add to the overall big picture of what's going on economically. Here's the Stock Traders Almanac statistics. Now we're going to be dealing with the week after options expiration, where it tends to be pretty down. It's down 69.1% of the time in this particular study. But when you look at Monday, we're positive across the board with the Dow and NASDAQ, and even the S&P tends to have a positive day on that day. We will be on the 11th trading day, where we're following the green dash line and all the other indexes where we do see some upward movement, and we might get another day or two out of this before we start to see some more weakness going into the latter part of the month. This chart is suggesting that maybe this is it, or the 18th is going to be the last good day, maybe a little bit going into the 19th before we head into some historical weakness. And again, I'm not saying that's what's going to happen, but a lot of times this ends up being a self-fulfilled prophecy because the market sees this and it just kind of plays out the way they think it will. Looking at a longer term chart of the NASDAQ, we're kind of getting beyond this middle point where we were supposed to see a bounce as we head more into the weaker part of the month. And for the S&P, kind of the same thing. We've topped out, and now things could be getting weaker during pre-election years. And we're only up 33.33% of the time for September, going back to 1950 during pre-election years. So we're not going with the down one yet. We're not going with the up scenario yet. We're more leaning towards the sideways scenario because we're just not trending. We have an up day and things look better. We have a down day, things are looking worse, but we're just treading water at this point, which is a non-trending environment. We still have the trend signals above current price, and we're below that, but that's going to take some time to play out. We're coming into a weak month, and we might still have a few days left of this positive streak. The equity put call ratio is going up. The longer term equity put call ratio is going up. The risk on posture is showing weakness. The cumulative new highs, new lows, they continue to show weakness for the NASDAQ. The 3-month yield is still above where we were in 2007. The parabolic SAR is negative, and we're dealing with earnings season. On the positive side, we do have seasonality and setups. And if we get through this latter part of September, and let's say we do decline and establish some kind of a bottom that's a tradable bottom, things could turn positive after that. Or are we just going to continue to chop around and nothing's going to get decided and things will remain more gray? The daily special K chart is still positive. The weekly chart is negative. We're still above the downtrend channel upper line. Our oscillators are still giving us a mixed picture. We're turning a little bit more negative with the NASDAQ 100 oscillator that we're following. Even though it's still positive, it's rolling over. The utilities also, they have been seeing some recent strength there, but they're still underperforming the S&P. And the Staples to S&P 500 ratio, that we did tick up a little bit with this ratio, but overall it's been declining. The Russell, the small caps, and the mid caps do have recent golden crosses. Small and mid cap growth has been going sideways, but it's still positive. The financial sector is also working off of a recent golden cross. The Copic curve, the signal's almost gone now, but it's still a buy signal. So our conclusion, we're mixed and not trending, and we can say that for the short and intermediate term. Long term, we're still positive as long as we stay above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a great weekend. I will be posting other videos over the weekend, so I will talk to you in the next video.